Welcome to vTalkInsight, Market Drivers Daily for July 20th, 2026. Oil choke points are back in focus. AI spending plans are being questioned, and volatility is building beneath otherwise calm indices, making today a key moment for how equities and rates reprice. Escalating conflict around the Strait of Hormuz and the Red Sea is once again putting energy security at the center of the macro story. Commercial shipping through this critical route has largely halted, with visible oil exports from the Persian Gulf dropping well below normal and only partly recovering via pipelines and less transparent vessel movements. That disruption, combined with renewed strikes on energy infrastructure, creates a binary backdrop for oil prices and keeps growth and inflation outcomes unusually uncertain. Recent days have seen attacks on ships, strikes on dual-use infrastructure, and even a nuclear power plant in Iran targeted, while hostilities have spread to Kuwaiti assets and Gulf neighbors. This comes on top of an already tight refined product market, with record-high crack spreads for diesel and jet fuel and jet prices above $100 per barrel, echoing the refined products squeeze highlighted earlier this week. Ryanair's 34% profit decline, linked to higher fuel costs and softer demand, underlines how quickly these shocks can bleed into corporate earnings. Brent crude has traded above $90 and is still hovering in the high 80s, even after occasional dips when mediators opened channels with Iran or floated ceasefire proposals. Gasoline has moved back above $4 per gallon in the United States, while European natural gas futures are up around 5% and storage levels may struggle to reach 70% before winter, leaving Europe exposed. Bond markets are responding. European yields and UK gilts are edging higher on stagflation worries, and the US dollar remains well supported as a carry and safe haven play in this energy-driven environment. For policymakers, this is a difficult mix. Treasury forecasts in the UK now factor in weaker growth, higher inflation, and even scenarios where crude could spike toward $150 if Middle East conflict escalates. Higher oil is already weighing on European equity futures and hitting travel names. Yet it also reinforces long-term themes such as rising European defense budgets and renewed interest in domestic energy production, from North Sea drilling plans in the UK to broader efforts to reindustrialize around cheaper power. At the same time, central banks have limited tools to offset an oil shock, which keeps them cautiously hawkish even as core inflation has improved. There is, however, a credible counter-narrative. Diplomatic comments from Istanbul, reports of U.S. outreach to Iran, and Iran's openness to mediator proposals have briefly knocked a couple of dollars off Brent and eased the risk premium. Crude flows through Hormuz have already bounced back toward roughly 80% of normal thanks to alternative routes, and global equities, including S&P and Nasdaq futures, remain relatively resilient, suggesting markets still assume conflict will stay contained. The key watch points now are shipping and insurance conditions through Hormuz and the Red Sea, refined product spreads, and whether gasoline stays above $4, because those will determine whether this remains a manageable premium or flips into a full-blown supply shock that forces a broader repricing across equities, rates, and FX. With that backdrop, the next question is how the AI investment cycle copes with both higher energy costs and rising geopolitical friction. Artificial intelligence is still the main engine behind the global capex and earnings story, but the debate has shifted from raw spending to who actually captures the economics. Compared with a few days ago when attention was squarely on a powerful multi-year AI hardware cycle, today's focus is much more on competition, cost efficiency, and geopolitical fault lines in the AI stack. That shift matters because equity leadership, credit issuance, and even macro growth forecasts are now tightly linked to AI investment plans. Leading U.S. frontier models still offer superior token and compute efficiency for complex, high-value enterprise tasks, but Chinese players are closing the gap fast. Alibaba has previewed a new model that it claims is on par with top frontier systems. Its shares are up on the news, and firms like Moonshot are releasing multi-trillion parameter models that run competitively even on older or substitute chips. Some Chinese open-source models reportedly deliver up to 90% lower costs, and U.S. corporates now account for a large share of their token usage, which is forcing global firms to rethink AI procurement and pricing. On the spending side, hyperscaler and big tech capex is projected to approach $800 billion next year, with AI-related projects also driving around 18% of investment-grade bond issuance so far this year. One company has lifted revenue targets above $4 billion on the back of nearly $3 billion in new multi-year AI contracts, while Google Cloud's strong backlog and an expected 17% increase in search revenue highlight the near-term monetization potential. Yet, open weight and sovereign models are rapidly narrowing the performance gap, which pushes value toward infrastructure, power grids, and proprietary customer data rather than the models themselves. Return on investment scrutiny is intensifying. Some management teams now question whether rising token and infrastructure bills justify the benefits, with examples like Coinbase cutting its AI costs roughly in half by shifting toward open-source solutions. Banks are managing AI outlays via subscription models and strict business case vetting, while service providers move toward outcome-based pricing to give clients more transparency. At the same time, U.S. authorities are weighing tighter controls on Chinese AI models and compute exports, which could disrupt cheap supply chains, but also create headaches for non-AI sectors that have grown reliant on low-cost tools. There's a counter-view that some of the disruption fears are overstated. Many U.S. corporates are unlikely to place critical data on Chinese platforms regardless of cost, and increased competition from allied sovereign models may pressure token prices without overturning the dominance of leading U.S. providers or forcing a wholesale rotation in hardware demand. So far, there is little sign of market-based pushback on hyperscaler capex intentions, even though industrials tied to the AI build-out now trade on rich valuations, and equity investors remain willing to fund the capex cycle. The main watch points from here are upcoming earnings from the major cloud and AI platforms, their capex and power grid plans, any fresh regulatory steps on U.S.-China AI flows, and how quickly leadership rotates within the AI trade, because those will shape both growth expectations and market concentration risks. All of this leaves indices heavily reliant on a narrow group of AI-linked names, which feeds directly into the current backdrop of fragile, event-driven volatility. Headline volatility still looks contained, but under the surface market structure is becoming more fragile and more reliant on a narrow set of themes. Semiconductor and AI-related stocks have led the latest drawdown, with one AI equity index down almost 19% from its peak and the Nasdaq 100 breaking below short-term support as its 50-day average rolls over. At the same time, the broader growth backdrop has remained surprisingly resilient, which has made selling volatility a frustrating, but so far workable, strategy in major currency pairs. Near term, the key event risk sits around technology earnings. Chip names such as Intel, AMD, and NVIDIA are rebounding into a pivotal week that includes results from Alphabet, Tesla, and other megacaps, with markets now demanding clear evidence that massive AI-related capex will translate into sustainable profits. There's a growing fear that even strong numbers from names like Google may not spark a broad rally if investors decide the good news is already priced in, which would raise the risk of a sharp, narrative-driven reversal. Layered on top are crowded AI exposures across many portfolios, heavy use of leveraged exchange-traded products and ultra-short-dated options, and a warning from some participants that the next downturn, once it starts, could be both significant and rapid. Rates markets add another dimension. Consensus sees only a minimal chance of a Federal Reserve rate hike at the next meeting, yet inflation risks from higher energy keep yields biased higher, particularly in Europe and the UK. There is also concern that the second half of the year will bring much heavier municipal bond supply, which could amplify price swings if investor demand fails to keep pace. In credit, AI-driven capex has fueled a surge in investment-grade issuance, supporting liquidity for now, but potentially increasing sensitivity to any reassessment of the AI growth narrative. Political risk is another quiet source of optionality. In the UK, the prospect of Andy Burnham becoming the seventh prime minister in just over a decade, alongside uncertainty over the new chancellor, raises the odds of sudden moves in gilts and sterling if the cabinet lineup surprises markets. At the same time, the country faces strategic choices over defense commitments, energy policy, and its position between U.S. and EU priorities, while U.S. legislative gridlock delays any fresh fiscal support or Pentagon funding until at least September. Combined with unresolved Middle East tensions and possible shipping disruptions at multiple oil choke points, these factors add to the list of catalysts that could trigger volatility spikes across assets. The counter-argument is that markets have already absorbed several waves of bad news without a systemic spike in volatility. Global growth has stayed resilient. Major equity indices are off their highs, but not in crisis territory, and G3 and G4 currency pairs remain broadly range-bound. From here, the balance of risks hinges on whether energy shocks intensify, AI earnings and capex disappoint, or political events deliver real policy surprises, versus a scenario where conflicts remain contained and the AI investment cycle continues to support earnings. Key indicators to monitor include breadth and depth of any equity sell-off, liquidity conditions in oil and credit markets, realized volatility around tech earnings days, and cross-asset correlation behavior, because these will determine whether volatility spikes are short-lived trading events or the start of a more durable regime shift. To sum up, energy choke points are keeping a persistent risk premium in oil and refined products. AI remains the core driver of capex and earnings, but with rising questions over who captures the profits. And market structure looks increasingly fragile as these themes intersect with heavy event risk and political uncertainty. Watching shipping data through Hormuz, big tech earnings and capex guidance, and the behavior of rates and credit around any volatility spikes will be critical for understanding how equities and bonds reprice from here. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.